Hey there, Finance fam. Hand-waving welcome back to Finance Fundamentals Explained, the channel where we break down complex finance topics into bite-sized, easy-to-digest pieces so you can grow your wealth without the headaches. Let me kick things off with a quick question. How often do you open up today's share market news, thinking, alright, let's get rich, only to feel like you've stepped into a financial version of the Matrix? It's all. Market dips 2% as inflation fears rise, or Dow surges on renewed optimism. Like, what does that even mean? How does it help me grow my money? And more importantly, how do I avoid the epic fails we see from people chasing hot stock tips on social media? Don't worry, you're in the right place. In today's episode, we're decoding share market news today. I'll not only break down what's happening but also arm you with 3 practical tips to make sense of it all, avoid mistakes, and level up your investing game. Stick around, because I'm also going to share one of my most embarrassing market mistakes. It involves me, a meme stock, and a $2,000 lesson I'll never forget. Trust me, you don't want to miss that. Ready to dive in? Let's do this. Tip number 1: decipher the headlines. Hype versus helpful. Alright. Let's kick things off with the first, and probably the most crucial, tip. Learn how to decipher the headlines. Here's the thing. Not all news is created equal. A lot of what you see in financial media is designed to grab your attention, not necessarily to educate you. Headlines like 1. XYZ stock to explode, you won't believe why. 2. Market meltdown, is your money safe? These are meant to spark panic or FOMO, fear of missing out. Neither of those emotions leads to smart investing decisions. Let's take a real-world example. Remember when tech stocks were allegedly doomed in late 2022? Everyone was freaking out. But the smart investors, the ones who ignored the hype, used the dip to buy quality companies like Apple and Microsoft at a discount. Today? They're laughing all the way to the bank. Actionable tip. Whenever you see a scary or exciting headline, pause and ask yourself. 1. Is this news backed by data? 2. How does it align with long-term trends? 3. Is it relevant to my investment strategy? I once sold all my shares of a promising company because a flashy YouTuber predicted a total crash. Guess what? The stock doubled 6 months later. Loudly crying, that's when I learned. Trust facts, not fear. Tip number 2. Use metrics to decode the market. Moving on to tip number 2. Use metrics to cut through the noise. Bar graph. This is where we get a bit nerdy, but hang with me, it's worth it. Metrics are like the DNA of the stock market. They help you understand whether a stock or sector is actually worth your attention. Here are 3 metrics you must know. KeyCap 1 P/E ratio, price to earnings. This tells you if a stock is overvalued or undervalued. KeyCap 2 volume. How many people are trading this stock? Low volume equals higher risk. KeyCap 3 EPS, earnings per share. This shows you if a company is consistently making money. Let's break it down with an example. Tesla. Tesla's stock tends to swing wildly because of hype and speculation. But if you focus on the metrics, like delivery numbers, cash flow, and growth rate, you can filter out the noise and make smarter decisions. Pro tip. Bookmark tools like Yahoo Finance, TradingView, or simply Wall Street. They make it super easy to get these insights without needing a degree in finance. Here's a fun one. I once bought a stock just because it was trending on Reddit. Melting face. No research, no metrics, just vibes. Spoiler alert. It tanked, and I lost $500. Now, I always check metrics first. Lesson learned the hard way. Tip number 3. Diversify news sources. Finally, tip number 3. Don't put all your trust in one news source. It's like eating only fast food, convenient, but definitely not healthy. The same goes for market news. If you're only watching one YouTuber, reading one blog, or following one Twitter account, you're setting yourself up for bias. Here's how you can diversify. 1. YouTube channels. Watch a mix of creators, some that focus on trends, like Graham Stephan, and others that deep dive into data. 2. Podcasts. Check out We Study Billionaires or the Investors Podcast. 2. These are pure gold for understanding the bigger picture. 3. Newsletters. Sign up for Morning Brew or Seeking Alpha for quick, reliable updates. Pro tip. Set Google alerts for specific stocks or sectors you're interested in. That way, you get a curated list of updates without drowning in unnecessary info. True story. I used to rely solely on CNBC for market updates. Turns out, they're great for big picture news but not so much for individual stock analysis. Once I diversified, I started spotting trends earlier and making better decisions. Alright, let's recap. Keycap 1. Decipher the headlines. Don't fall for hype or fear. Keycap 2. Use key metrics to make data-driven decisions. Keycap 3. Diversify your sources for a well-rounded perspective. The share market can seem overwhelming, but with the right tools and mindset, it's absolutely manageable. Remember, it's not about chasing trends, it's about building a strategy that works for you. And hey, if you found this video helpful, do me a favor. Right finger hit that like button. It really helps the algorithm show this video to more people. Right finger subscribe to Finance Fundamentals Explained for more tips to grow your money smarter, not harder. Right finger drop a comment below. What's your go-to source for share market news? I'd love to hear your thoughts.